Inflation is exploding higher. The CPI, Consumer Price Index, just came out at 9.1%, the highest level of inflation we have seen since 1981. This begs the question, are we headed into an inflationary depression? I'm going to try to answer that question for you right now in 3 simple, fast steps. Step number 1, let's go over what I am calling deflationary inflation. And I know that sounds like an oxymoron, but bear with me. I think this is the economic environment that we are in right now, and we will most likely continue to be in throughout 2022 and 2023. So this is a chart of the S&P 500 going back to, we'll call it mid-2021, all the way to today's date. On the left, we go from 3,500 up to 5,000. Throughout 2021, for the majority of it, the S&P 500 was going up. Why? Because of stimulation. I call it the stimmy era. So instead of a bull market, it's a stimmy market. They got all that free money, and that was flowing directly into the stock market.
How to turn your $600 stimmy into $13,000. Stocks to invest in 2021.
There were a lot of other variables involved, but this is one of the major contributing factors. Then what happened in the beginning of November is Jerome Powell came out and said that they were going to think about hiking interest rates and think about quantitative tightening. They didn't actually do it, but just because the Fed started talking about being a little more hawkish, the market starts to go down. And then the Fed actually starts to raise rates. And recently, they've started quantitative tightening. So what does the S&P 500 do? Goes straight down to a point where it is today, where it's lost almost 20% of its value. Think about what that does to 401ks, pension funds, and the average American's purchasing power. So let's think about this for a moment. Everything that the average Joe and Jane wants to continue to go up and up and up, things like asset prices, stocks, cryptocurrency, and housing, all of these things are going down, straight down, especially stocks and cryptocurrency. We'll have to wait and see what happens to housing, but we could be going into a downturn very similar to what we saw during the GFC. So we have this asset price deflation, while at the same time, all the stuff that you have to buy on a daily basis is going up in price. Things such as food, energy, and shelter. Then the things that you want to buy, you're not able to buy those. So then we have those prices going down. Things at Walmart, Target, Home Depot. So there you have corporate profits being squeezed. What does this do? This increases the unemployment level, which decreases the average Joe and Jane's purchasing power even further. We talked about the problems with excess inventories and corporate profit margins being squeezed in the last video. It's something called the bullwhip effect, and Michael Burry has been warning about this. But this bullwhip effect in and of itself is a paradox, just like the deflationary inflation that we are experiencing right now. Why do I say this? Because we have all this excess inventory while at the same time we have shortages because of supply chain disruptions. So think about this. You go to your local Whole Foods or Target. A lot of the shelves are barren. They don't have anything because they can't get that stuff from the wholesaler, from the supplier. But with all of the goods they can buy, they've ordered way, way, way too much, so those are actually on sale. Those companies, those retailers are fire selling all of the things that they could purchase because they over-ordered, but they couldn't purchase, they couldn't source all of the things that the consumer wants and needs. This is a perfect example of the economic distortions that are created by the government and the central planners, like the Federal Reserve, when they come in and try to meddle in the economy like they did in 2020 and 2021. So the main takeaway from step number 1, asset prices, which represent a significant portion of Americans' purchasing power, is in deflation, where prices are going down, while at the same time, the prices of the stuff you need to buy on a daily basis, food, energy, and shelter, is going straight up. So this takes us into this deflationary inflation. The question becomes, will it lead to an inflationary depression? Step number 2, now let's discuss the misery index. And before we go any further, let's try to define what an economic depression actually is. Most people would say it's long-lasting high unemployment, so like an entire decade or several years. Also, severe economic contraction. Okay, fine, but what does this boil down to? I mean, at the end of the day, why is a job important? Because it gives you purchasing power. So really, what an economic depression means for all of you watching this video right now, or the average Joe and Jane, Americans in aggregate total, or global citizens, really doesn't matter what country you're in, it means your purchasing power and your standard of living goes down. And I know a lot of your friend and family member Fred would say, "Oh, George, how can you even insinuate that we might be going into an economic depression? That is absolute crazy talk. I don't see anyone standing in line for bread or doing any of these things that we saw during the 1930s. Okay, fine, but remember, today we have food stamps, or whatever politically correct term they're giving it now. We also have stimmy checks. We also have ways to give people the things that we gave them back during the 1930s in a very discreet way, in a way that you most likely wouldn't even notice. But my main point is that in economic depression, what it means for the guy on the street is their purchasing power goes down along with their standard of living. So let's go back to this very interesting chart. The misery index is actually pretty simple. It's just the headline unemployment rate plus the CPI. And as my good buddy Jason Burrick says, the CP lie. because we know this is just the government numbers that they fudge and they understate the true rate of inflation. But for the sake of this example, we'll go ahead and run with it. So this chart goes back to 1970. Actually, the original chart goes back, I believe, to the 1950s. Editor, go ahead and throw that up. But I wanted to start with the 1970s because it helps me illustrate the concepts even better. And this chart goes all the way to today's date. On the left, we go from 0% up to 25%. So starting in 1970, the misery index, in other words, unemployment rate plus consumer price inflation, was about, we'll call it 12%. And then throughout the 70s, a very, very bad decade for the average Joe and Jane when it comes to their purchasing power and standard of living as measured by the misery index. We get all the way up to, let's say, 22, 23%. And by 1979 or 1980, we get all the way up to almost 25%, a staggering number. Then it comes down to a more normal level. Then during the cerveza sickness, because of the unemployment rate, it shoots back up to a level around 15%. But then it comes right back down because we have low levels of employment now, at least historically speaking. But because of inflation going higher and higher and higher, the misery index, as it stands today, is at 12.7%, a 9.1% CPI plus an unemployment rate of 3.6%. So you may be saying to yourself right now, okay, George, I get what you're saying here, but at 12.7%, we're nowhere near where we were in the 1970s. And, oh, by the way, if you go back to the 1930s and do the back of the napkin math, we were at a similar level of the misery index as we saw during the 1970s. So let's say 1979, we were up to about 25%. If you look at the 1930s, unemployment was about 25%, but we had, let's say, 2% deflation. So that brings the misery index down to about 23%. And my whole point here is the 1970s, as far as the economic pain the average Joe and Jane were feeling, very similar to what we saw in the Great Depression during the 1930s. But for a moment, let's go back to why the unemployment rate matters. Why is it a big deal when you're measuring the misery index? Because we associate, rightfully so, employment with purchasing power. So if you have a job, theoretically, you can put food on the table. You can buy gas. You can pay your rent. You can pay your mortgage. And without a job, you can't do those things. So we talk about them as though they are synonymous, like they're one and the same. But are they in 2022? See, I would argue that today our economy and the average Joe and Jane is far more dependent upon asset prices for their purchasing power and standard of living than they were during the 1970s and the 1930s. Whoa, time out. To illustrate this idea even better, editor, let's go ahead and cut to a chart of American net worth in aggregate total as a percentage of GDP. And we go back to the 1970s and we see that it was about 350%. But look at where it is today, over 600%. This just goes to show you how dependent American consumers and the US economy are on asset prices. So I think today, to get a true measurement of the misery index to where we're comparing apples to apples, you also have to include the decline in asset prices that we were talking about in step number 1. So now I think the new measurement should be the unemployment rate plus the CPI plus the decline in, call it the S&P 500, cryptocurrencies, housing, etc. So the bottom line and the key for step number 2 is we need to adjust this measurement, in my opinion. We need to also consider all the factors that go into the average American's purchasing power and standard of living today in 2022. And I think when you add the asset price decline to this equation, it wouldn't be a stretch to assume that the misery index would go from 12.7 all the way up to a level that was consistent with the 1970s and the 1930s during the Great Depression. Step number 3. Now let's try to answer the question, are we entering an inflationary depression? And to think this through, I want to start by going to the person or the entity that is far, far smarter than I will ever be. That is Mr. Market. So what signals is Mr. Market giving us? What is he predicting about the rest of 2022 and 2023? Is Mr. Market predicting an inflationary depression? Well, let's start by going back to this chart of the CPI. Going from 2002 all the way to today's date, from negative 5% up to 10%, we can see we go down to deflation in the GFC, but we quickly go right back up to where we were at levels of inflation, although relatively speaking, they were pretty darn low, maybe 1-2%. We kind of hover around that line until we get to 2020. Prices go down. I think we might have experienced almost some deflation, probably got down to 0. But then you know what happens. The government distortions come in, they lock everyone in a cage, they destroy the supply chains and they give out stimmies. So they decrease supply while they increase demand. What is that going to do to prices? It's going to send them exploding higher, which is exactly what is being captured by the most recent CPI print of 9.1%, the highest consumer price inflation we have had since the early 1980s. So what are the markets telling us? What are they predicting now that we got this 9.1% CPI print? You would expect the bond yields to explode higher because investors are lending their money to the US government, and you would expect, if we are going to see higher and higher inflation, that the bond yields would have to shoot up because those investors have higher inflation expectations going into the future throughout the rest of 2022 and into 2023. Well, gold is an inflation hedge, so you would expect the price of gold to also scream higher, along with oil, copper, and the dollar you would expect to fall. But what has actually happened? Editor, let's go ahead and throw up some charts. We'll start by looking at the 10-year Treasury yield. And you can see just before we got the CPI announcement, which told us that the rate of inflation was higher than it's been in 40 years. The 10-year Treasury was trading at about 2.95%. And if we look at it today, it's almost at the exact same yield, meaning that nothing has changed even though we got this astronomically high inflation print just the other day. Well, what has happened to the 1 year and the 2 year? Well, they spiked higher. They've come down a little bit, but not as much as the 10 year. What does this tell us? That we have an inversion of the yield curve because the interest rates on the 1 year and the 2 year are higher than the 10 year. And the 10 year is going down at a faster rate, meaning the inversion is getting more and more extreme. There is no better predictor of economic recession or even a depression than an inversion in the yield curve between the 1 year, 2 year, and the 10 year. Next, let's move on to the gold market, which you would expect the price to have gone parabolic. And we can see that the price is actually down, not up. How about oil? Same exact thing, price down. And Dr. Copper, this is a key. Why? Because this is another historic indicator of recession. Usually when the copper price plummets, it means that we are headed into, if not already in, an economic recession. And what has the price of copper done lately? It's gone straight down as well. And lastly, let's look at the dollar, which you would expect to go down on this inflation news, and it's gone straight up. In fact, today, which is July 14th, Thursday, the dollar hit a 52-week high of over 109 on the DXY. So the bottom line is the market signals you would expect if we are going into a recession, if not an economic depression, would be an inversion of the yield curve, lower bond yields, especially at the long end, gold price going down, oil down, copper down, and dollar up. And that's exactly what we are seeing play out right in front of our eyes. So right about now, you may be scratching your head and saying to yourself, okay, George, I get what you're saying here, but if all of these prices are going down, if we get this inversion, if bond yields are going down, doesn't that mean that we'll have a deflationary recession or a deflationary depression? And that's a good observation, but I would use oil as a proxy. It has crashed lower, signaling exactly what we're talking about, but it's still at a very high level because of the supply constrictions and the messed up supply chains, the distorted supply chains, the economic distortions that were created by the government in 2020 and 2021. And that is not something that you can fix overnight. That's why my base case is that if we go into an economic slowdown, or let's call it an extreme economic slowdown, the CPI may come down momentarily, but I don't think they're actually going to go lower to where we would see deflation. They might go down to 3, 4%, but I think they'll go right back up because of the damage that has been done by the central planners and the authoritarians to the supply chain, and what the government's response would be to signals that we're going into a recession, if not a depression, and that would be more stimmy checks, more currency units, more government deficit spending, which would take us right back into the next wave of inflation, consumer prices going up, while economic activity was continuing to decline. So are we headed for an economic slowdown? There are no certainties, only probabilities, but I think the probabilities are extraordinarily high when you look at the market signals. So is it going to be a recession or depression? Is it going to be inflationary, disinflationary, deflationary? I'll let you be the judge. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here. I will see you on the next video.